Welcome to this presentation on an illustration of the normal tax calculation of a small business corporation. In South Africa, income tax is imposed by the Income Tax Act on any person. The term person includes both natural persons and legal entities, for example, companies and small business corporations. The liability for income tax is calculated on an annual basis and is referred to in the Income Tax Act as normal tax. Normal tax is levied on the annual taxable income of the person or entity at either a fixed rate or at progressive rates, also called sliding scale rates. A progressive tax rate means that the higher the tax base, that is the taxable income, the higher the rate of tax. Certain entities like companies, closed corporations and ordinary trusts are taxed at a fixed rate of normal tax, which is currently 27% per year. Whereas natural persons, including special trusts and small business corporations, are taxed at progressive rates. South Africa also has a simplified tax, namely turnover tax, that is levied on the turnover of a micro business in lieu of normal tax levied on taxable income. Turnover tax is also a progressive tax and therefore also levied at sliding scale rates. This presentation will illustrate how to calculate the normal tax liability of a small business corporation by using the sliding scale rates. The normal tax rates, which are amended on an annual basis, that apply to a small business corporation for the year of assessment ending on or after 31 March 2023, is set out in this table. As you can see, there are different tax rates for each separate tax bracket. As the taxable income increases, the tax rate also increases. The first tax bracket indicates that 0% tax is levied on the first 91,250 rand of the taxable income. The second bracket applies to the taxable income exceeding 91,250 up to 365,000 rand, and so on. Let's look at an example. DEF Pty Limited qualifies as a small business corporation in terms of Section 12 capital E of the Income Tax Act and has a 30 June financial year end. Assume that DEF's taxable income for the 23 year of assessment amounts to 485,000 rand. During the 23 year of assessment, DEF also made the two required provisional tax payments as follows: 5,800 on 31 December and 17,300 on 30 June. We will now look at how to calculate the normal tax liability of DEF for its 23 year of assessment. Because DEF is a company, its year of assessment will always be the same as its financial year. DEF's 23 year of assessment therefore ends on 30 June 2023. First, we need to identify the tax bracket in which DEF's taxable income of 485,000 rand will fall for the 30 June 23 year of assessment. If you look at the third bracket in the tax table, you can see that this amount falls between 365,000 and 550,000. So we will use this bracket in the calculation. From the rates provided in the table, you will see that it consists of two parts. a given amount of 19,163, which is the normal tax on the first 360,000 rand of taxable income, and a tax rate that needs to be applied to the taxable income amount above the 365,000. The normal tax on the first 365,000 rand taxable income is given in the table as 19,163. Therefore, we start our calculation by calculating the amount of taxable income above 365,000. That is the taxable income of 485,000 rand less 365,000 rand, which will give us 120,000 rand. The normal tax on this 120,000 rand of taxable income is calculated by applying the rate of 21%. And when calculating this, the answer is 25,200. Therefore, the total normal tax liability for the 23 year of assessment is then 44,363, which we get when we add the 19,163 that was given in the bracket to the amount that was calculated of 25,200. Mathematically, the calculation is written as follows. Take note that when you do this calculation, you need to keep the basic rules of mathematics in mind. Also take note that the type of calculator that you use, or depending on the settings on your specific calculator, there may be different ways in which to enter the calculation to get to the correct answer. And here we've noted two methods. In the first one, you can see it's not necessary to use the equal sign, while with other calculators, it may be necessary to use the equal sign before you carry on doing the calculation in order to come to the correct answer in both instances. This table indicates the calculation of the normal taxes still owing to the South African Revenue Service by DEF on assessment, which is 21,263, after the deduction of the normal tax that was prepaid as provisional tax payments during the year of assessment. From this information, the following can be analyzed. DEF's average rate of normal tax for its 23 year of assessment is 9%. And you get to the 9% by dividing the total tax payable, 44,363, with the total taxable income of 485,000 rand. Up to a taxable income of 550,000, DEF's marginal rate of tax is 21%. Once DEF's taxable income exceeds 550,000, the marginal tax rate on the amount above 550,000 will be 27%. So for any R1 of taxable income earned between 365,000 and 550,000, 21 cents will become payable as normal tax, and the corporation will keep 79 cents. This information can be used by DEF for decision-making purposes in the business. Sliding scales for tax has the effect that the lower income earners pay less tax than higher income earners. This is very common for taxpayers who are natural persons. Small business corporations in South Africa also have this benefit, which aims to encourage and stimulate the growth of small businesses and to increase employment rates. We trust that you found the presentation insightful and that you will be able to calculate the normal tax liability of a small business corporation by using the rates of normal tax.